Hi there, it's Friday the 21st of December 2018. I'm Steve Towers. Welcome to ITB. Let's get started. As this is our last show for 2018, let's review this year's top 10 international tax stories. In my humble opinion, of course. At number 10, there's the MLI, which entered into force on the 1st of July 2018. It will first be effective in regard to withholding tax under 47 double tax treaties for payments made on or after the 1st of January 2019. In the last few months, we've seen a flurry of so-called MLI synthesized texts, and notably, the Irish and Maltese competent authorities based their agreement in regard to stopping the so-called single malt structure on the new preamble which is provided by the MLI. At number 9, we have governments buckling to popular pressure. We saw a number of examples of this in 2018. Most prominently, the decision of the French government to suspend the fuel tax increase for 6 months in response to the Yellow Vest demonstrations. And speaking of fuel, there was the Kenyan government's tactical retreat to impose only an 8% VAT charge on petroleum products instead of the originally announced 16%. In Benin, the social media tax lasted only 3 days before it was scrapped by the government. And even in China, the tax authorities backtracked in regard to a proposal to stop applying a preferential income tax rate to venture capitalists. But in Spain, far from buckling to popular pressure, the government rode a wave of public sentiment to change the law, to reverse the effect of a Supreme Court decision regarding mortgage documentation tax. At number 8, we have indirect taxes. And the most notable item here is the Wayfair case in the US, which has resulted in a significant increase in the ability of US states and territories to impose sale and use tax obligations on vendors which have no physical nexus with the jurisdiction. In regard to VAT, a number of countries have introduced VAT systems, most notably several GCC members, Saudi Arabia and the UAE, effective the 1st of January 2018, and Bahrain, effective the 1st of January 2019. But there have also been some countries which have repealed their VAT systems and replaced them with single-stage sales taxes, for example, Zambia and Malaysia. Also, in regard to VAT, a number of countries have expanded the scope of their VAT to apply to low-cost imported goods. For example, Australia, the 1st of July 2018, Switzerland, the 1st of January 2019, and New Zealand is planning to do so effective the 1st of October 2019. And I've lost count of the number of countries which have imposed VAT on inbound digital services. And finally, of course, there were quite a few VAT developments in the EU. More about them later. Coming in at number 7 is transfer pricing. During 2018, the OECD issued its final reports on the attribution of profits to PEs and the profit split method. It also issued a draft report on the transfer pricing aspects of financial transactions. A number of countries introduced transfer pricing rules during 2018, for example, Egypt and Saudi Arabia. And there were a number of interesting transfer pricing cases during the year. More about those later. And of course, transfer pricing is at the heart of the current debate on digital taxation. More about that later as well. At number 6, we have the EU, and this has been a very busy year. All of the member states have been implementing into domestic legislation significant parts of ATAD 1 and the 2017 VAT Directive. In regard to state aid cases concerning tax rulings, the European Commission made an embarrassing backdown in the case involving McDonald's and Luxembourg. But it issued decisions during the year asserting illegal state aid in regard to Engie and Luxembourg and also in regard to Gibraltar. The European Commission was recently in a dispute with Italy in regard to that country's 2019 budget, and it said that it might impose a penalty in this context for the first time. However, in true European fashion, a compromise was reached this week. In other developments, the DAC 6 initiative in regard to disclosure of transactions entered into force in June 2018. Member states have agreed to apply these rules beginning the 1st of January 2020. There were a number of VAT changes during the year. Firstly, ECOFIN adopted a series of 4 initiatives which are designed to improve the current VAT system before the introduction of the so-called definitive VAT system. And secondly, the European Commission has issued 3 proposals concerning distance sales of goods and in particular online marketplaces, payment service providers and administrative cooperation. And the European courts decided some interesting cases. More about those later. Coming in at number 5 is global trade. And all of the year's big trade stories involve the US one way or another. The US significantly increased tariff rates on steel products and aluminum. The US, together with Mexico and Canada, signed the USMCA after President Trump threatened to terminate NAFTA. The US signed a revised free trade agreement with Korea. And of course, there's the ongoing China-US trade war. And despite the US withdrawal from the Trans-Pacific Partnership, the remaining 11 countries signed a multilateral free trade agreement which goes into force on the 30th of December 2018. At number 4 is BEPS Action 5 on preferential tax regimes. In previous years, we saw OECD members amending their tax incentives in order to be compliant with BEPS Action 5. This year, a large number of non-OECD members did so as well. For example, Barbados, Guernsey, Hong Kong, Isle of Man, Jersey, Macau, Malaysia, Mauritius, and Thailand. But what's particularly striking are the tax havens, which the inclusive framework calls no or only nominal tax jurisdictions, which are introducing an economic substance test. In last week's ITB, I told you about the Cayman Islands. Well, the BVI government has announced that it will do something similar. At number 3, we have cases. I'll deal with the non-EU cases first and then the EU cases. Outside of the EU, I would list 5 international tax cases in 2018 which are significant. In Canada, the Cameco case, which concerns the sham principle and Canada's transfer pricing rules. In the US, the Altera case, which concerns the US cost-sharing regulations in regard to stock options. This is the case where one of the judges died before the appeal decision was delivered, and the new panel directed that the appeal be reheard. In Canada, the Alta Energy case, in which the tax authorities failed in their attempt to apply the GAR provision in a treaty shopping situation. In Australia, the Satyam case, in which the Australia-India Treaty was held to increase Australia's taxing rights. And in the UK, Fowler's case, in which a domestic law deeming rule was held to cause a recharacterisation of income for the purposes of the South Africa-UK Treaty. And in regard to cases decided by the European courts, here's my selection. This is the first tranche on the freedom of establishment and the free movement of capital. I won't read them out. Please hit the pause button to study the list. And here's the second tranche on VAT in holding company situations and on state aid. Please hit the pause button. Coming in at number 2 is the US tax reform. Yes, I know that the relevant legislation was passed and signed in 2017, but the significant story in 2018 is the impact of that legislation. Firstly, we've had a number of proposed regulations issued by the US government on the transition tax under Section 965, on GILTI, including 2 significant anti-abuse rules, on Section 163J, on foreign tax credits and in particular the allocation and apportionment of deductions, and on the BEAT tax. Secondly, several aspects of the US tax reform are under international review, in particular FDII, the Foreign Derived Intangible Income, in regard to BEPS Action 5. And thirdly, during 2018, many countries have reduced their corporate tax rates or introduced other corporate tax incentives in response to the US tax reform. Notable examples include China and Canada. And the number one story in 2018 is, of course, digital taxation in all its interesting aspects, including these. We started the year with the 2 sets of proposals which were issued by the EU and the OECD, respectively. Each of the proposals considered a short-term solution and a long-term solution. In the EU, most of the focus for the rest of the year has been on the proposed short-term solution, the Digital Services Tax, DST. After a lot of negotiation, the proposal was not adopted at the most recent ECOFIN meeting. At the present time, it remains unclear whether the DST will ever be adopted by the EU. But that won't stop some EU member states introducing a DST on a unilateral basis. By my count, there are 4 member states, the UK, Italy, Spain, and most recently France, which have undertaken or have announced such a move. And outside the EU, a DST is being studied or has been announced by several countries, including Australia, New Zealand, Mexico, Korea, and Chile. Also, some countries have expanded the scope of their withholding tax rules to apply to outbound digital service payments, although generally subject to treaty limitations. For example, Taiwan. And in regard to a long-term solution, India has announced an expansion of its taxable presence rule to include a significant economic presence concept. But again, this will be subject to treaty limitations. And significantly, the OECD, through the Task Force on the Digital Economy, is currently pursuing 3 so-called ideas or solutions. One based on user participation, a second involving a broad-based expansion of the market country taxing rights, and the third involving a global minimum tax and possibly a restriction on deductions for outbound base erosion payments. Well, the French government has decided to accelerate its introduction of DST. After the most recent ECOFIN meeting failed to adopt the DST, the French finance minister said that France would give the EU until March 2019 to reach a decision to adopt the DST, failing which France would implement the tax unilaterally. Well, it looks like the 10 billion euros in emergency spending, which was recently announced to try to appease the yellow vest demonstrators, has caused a change in timing. This week, the finance minister said that the DST will definitely be introduced effective from the 1st of January 2019. Details of the new tax are expected to be released this week. So far, it looks like it will be similar to the DST which was proposed by the European Commission. 3% rate imposed on revenue from online advertising, sale of user data, and digital platforms. And it would apply to companies with annual global revenue exceeding 750 million euros. In Australia, you'll remember that the government in November announced changes to the petroleum resource rent tax. I covered this in ITB on the 9th of November. Well, the government has now released draft legislation on this topic for public comment. For a copy of the draft legislation, please go to our website. And also in Australia, the tax authorities have released draft guidance on the hybrid mismatch rules, which take effect on the 1st of January 2019. The draft guidance considers the meaning of the terms structured arrangement and party to the structured arrangement. For a copy of the draft guidance, please go to our website. The current truce in the China-US trade war seems to be holding, although Canada is receiving collateral damage. China has announced the temporary suspension of additional tariffs on US motor vehicles and parts for 3 months from the 1st of January 2019, matching the US suspension of a 25% tariff on a wide range of Chinese goods. But there are now 2 and possibly 3 Canadian citizens in custody in China in an apparent tit-for-tat for the Canadian arrest, at the request of the US, of a senior Huawei executive. In Indonesia, the government has amended its tax holiday regulations. There are 2 main changes. Firstly, the minimum amount of new capital investment to qualify for a tax holiday has been reduced to 100 billion Indonesian rupiah, which is about $7 million US. The minimum amount was previously 500 billion rupiah. And the number of industrial sectors which are covered by the tax holiday program has been expanded to 18, including digital economy. In Japan, the ruling coalition released its 2019 tax reform outline. 3 items caught my eye. Firstly, there will be several amendments to the transfer pricing rules, effective the 1st of April 2020. The discounted cash flow method will be added as an acceptable transfer pricing method. The tax authorities will be allowed to make pricing adjustments in regard to hard-to-value intangibles subject to conditions, and the statute of limitations will be increased from 6 to 7 years. Secondly, the earnings stripping rules will be amended in line with BEPS Action 4, also effective the 1st of April 2020. The current limit of 50% of adjusted taxable income will be reduced to 20%. The base for the calculation, adjusted taxable income, will be reduced by not adding back tax-exempt dividends. And the rules will apply to both related party and third-party interest payments. However, certain interest payments will be excluded from the rules. For example, interest which is included in the Japanese taxable income of the recipient and interest on certain bonds. And thirdly, the CFC rules will be amended, effective the 1st of April 2019. The amendments will exclude certain companies from the scope of so-called paper companies. For example, a US LLC will be excluded if its underlying assets satisfy certain conditions. And now to Malaysia. In last week's ITB, I mentioned the updated guidance which has been released by the tax authorities in regard to withholding tax on so-called special classes of income. There's an interesting double tax treaty issue in the updated guidance. If a particular treaty does not have an article which deals with fees for technical services, the updated guidance states that an outbound service fee should be dealt with by the other income article and not by the business profits article. Bearing in mind that the other income article in most of Malaysia's treaties has a provision similar to Article 21.3 of the UN Model Treaty, which allows unlimited source country taxation of income which arises in the source country, then this is a significant interpretation. It makes the absence of a PE in Malaysia irrelevant. There are quite a few advisors in Malaysia who will tell you to challenge that interpretation. The European Court of Justice has decided an important state aid case. Its importance is shown by the fact that the decision was delivered by the Grand Chamber, with 15 judges participating. The case concerns Germany's real estate transfer tax, RET. Under the relevant rules, an intragroup transfer of real estate is exempt from RET if certain conditions are satisfied. The transferor and transferee consist of a controlling company and a controlled company, and the controlling company has a 95% direct or indirect shareholding in the controlled company for the 5 years immediately before and after the transaction. The issue in the case was whether that exemption constituted illegal state aid on the basis that it was selective. In other words, not all transactions within a group would satisfy those conditions. The court said that the exemption is selective, but that is justified because it seeks to introduce a correction for the purposes of avoiding taxation that is considered excessive. That correction relates to the fact that the acquisition of 95% of the shares in a landholding company triggers an imposition of RET. If an internal reorganisation within a 95% group itself triggers an imposition of RET that would constitute double taxation. And the 5-year rule is designed to prevent abuse of the exemption. And so the court concluded that the intragroup exemption is selective, but it's also justified, and therefore it's not state aid. For a copy of this decision, please go to our website. And speaking of state aid, the European Commission has this week published the non-confidential version of its reasoned decision concerning the Luxembourg tax rulings issued to McDonald's. This decision was announced by press release in September. The Commission was forced to conclude that the rulings, which applied to the receipt of royalties by the US branch of a Luxembourg company, did not constitute state aid. For a copy of the reasoned decision, please go to our website. And also in regard to state aid, the European Commission has announced its decision that Gibraltar's corporate tax exemption regime for interest and royalties, which has now been amended, as well as 5 tax rulings, constitute illegal state aid. It has declared that the relevant companies must now return unpaid taxes of around 100 million euros to the Gibraltar government. For a copy of the Commission's press release, please go to our website. The standoff between the European Commission and Italy in regard to the draft 2019 budget has been resolved by compromise. For a copy of the Commission's press release, please go to our website. And if you're looking for something to read over the Christmas break, the European Commission has just published its Tax Policies in the European Union 2018 survey, all 182 pages. Your copy is waiting for you at our website. In Finland, the government has introduced into Parliament 2 items of proposed legislation worth noting. A bill which would reduce the VAT rate for certain electronic publications to 10%, effective the 1st of July 2019, and a bill which would rationalise the tax rules for investment funds, effective for the 2020 tax year. For copies of the 2 bills, please go to our website. And Norway will become the latest country to impose VAT and customs duty on low-value imported goods. Currently, there's an exemption for imported packages for consumers with a value less than 350 krona. The change will be effective the 1st of January 2020. In Poland, the government has announced the deferral of 2 initiatives. The first is the replacement of VAT returns by the collection of data from an expanded version of the standard audit file for tax. This initiative has been deferred from the 1st of January to the 1st of July 2019. The second is the introduction of new withholding tax restrictions for outbound dividends, interest and royalties. These new restrictions were intended to commence on the 1st of January 2019. They have now been deferred to the 30th of June 2019 for interest and royalties and to the 31st of December 2019 for dividends. In Romania, the government has proposed a number of measures, including a so-called greed tax on banks, in a desperate attempt to reduce its budget deficit and not breach EU limits. The greed tax, that's the government's term, is a levy which will apply to a bank's assets, with the rate dependent on interest rate levels in Romania. The proposed new tax has not been well received. The stock market in Bucharest plunged after the announcement. This is one to watch. In Turkey, the government has imposed a 15% withholding tax on outbound payments for internet advertising services, effective the 1st of January 2019. Presumably, the withholding tax is subject to treaty claims. And Turkey is swimming against the tide. It has increased the VAT rate on electronic publications to 18%, effective the 19th of December 2018. Previously, the rates were 1% and 8% depending on the type of publication. In Uganda, the government has announced that 18% VAT will be imposed on inbound B2C digital services, which are provided by registered non-resident suppliers. A non-resident supplier will be required to register if its annual taxable supplies exceed 15 million Ugandan shillings, which is about $4,100 US. Brazil has had a partial victory in a major trade dispute with the EU and Japan. The World Trade Organization's appellate body has delivered its decision in a case in which the EU and Japan challenged a number of Brazil's tax incentives as prohibited subsidies. For a copy of the decision, please go to our website. First there was the Cayman Islands, now BVI. Proposed legislation to introduce an economic substance test was being debated by the BVI Parliament this week in response to BEPS Action 5. In the US, the Treasury and IRS have released two sets of proposed regulations concerning the US tax reform legislation. Firstly, on sections 245AE and 267A in regard to hybrid dividends and certain amounts paid or accrued in hybrid transactions or with hybrid entities. And secondly, on section 864C8 in regard to foreign persons that recognise gain or loss from the sale or exchange of an interest in a partnership which is engaged in a trade or business in the US. For copies of the two sets of regulations, please go to our website. The US Treasury and IRS have also released Notice 2019-1, which indicates their intention to issue regulations with respect to foreign corporations with previously taxed earnings and profits. For a copy of Notice 2019-1, please go to our website. And finally, in the US, the staff of the Joint Committee on Taxation has released the so-called Blue Book on the US tax reform legislation. For a copy of the Blue Book, please go to our website. And now for this week's treaty developments. We've had 2 treaties signed, 1 protocol signed, 3 treaties enter into force, and 2 MLI synthesized texts published. Well, that's the way it is this Friday, the 21st of December 2018. The ITB team will be having a well-earned 2-week break. We'll be back full of life on Friday, the 11th of January 2019. Until then, I'm Steve Towers, wishing you all a Merry Christmas and a happy, healthy and prosperous New Year. And of course, have a great weekend.